Kenny, thanks for braving these downtown city elements. It's a little noisy around here, but that's okay. We can talk through the noise. So tell us about your background. How did you get into doing what you're doing?
Well, I was in my freshman year in college, and I had the opportunity to go work as a summer intern on the floor of the New York Stock Exchange, which I was a kid from Boston. I had every intention of going back to Cape Cod and being a lifeguard on the beach at 19 years old. I had no intention of moving to New York City in the middle of the summer. Like, it didn't make sense to me. Yet, I thought about it. You know, my first reaction was to say, no, I'm not interested. And then I thought about it over spring semester of my freshman year, and I decided, what's the worst that's going to happen? The worst that's going to happen, I'm going to go there. I'm going to have this experience. I'm not going to like it. I'll chalk it up for experience and move on. Or I'm going to go there and it's going to change the course of my life. And in fact, it changed the course of my life. It was the most dramatic, exciting place I had ever been to. And I had never been there before, right? I was a kid from Boston. I didn't grow up around the New York Stock Exchange. I didn't even know what the New York Stock Exchange was. I didn't know a buy from a sell, a stock from a bond, an eighth from a quarter, nothing. And that first summer, which was the summer of 1980, and I was 19 years old, and I moved to downtown New York City on Gold Street, that was like the financial district, so there was nothing going on there.
Right.
Rents were cheap, but the place was empty. Meanwhile, I moved in and went to work on the floor of the exchange, not really knowing anything, and spent that first summer as really an intern, as a gopher, right? Go for coffee, go for this, write reports, kind of learn, talk to people, read. And so that's what I did. But I have to tell you, I got there in May of 1980, and by the middle of June, it just bit me on the backside. It was the most exciting. Listen, 5,500 Type A personalities all in one room. You can imagine the energy level was up here every single day, no matter what the market was doing. And in 1980, remember, we had just come through the Jimmy Carter years. The economy was a disaster. Ronald Reagan had just become president. Interest rates were high. Unemployment was high. Inflation was high. And so it was not the best time in the world to be in financial services. And nor was the market really in a good place, right? The Dow was trading in the 800s. But yet, for me as a 19-year-old kid, it was the most exciting place in the world because everybody down there was a street smart kid they were from the boroughs, right? From Manhattan, from Queens, from Brooklyn, from Staten Island, but they were like street kids, right? My generation really was the first generation that had any formal education beyond high school. And that's not a negative. That was just the way kind of the world worked, right? Because on the floor of the exchange, you had to have it in your belly. You had to be street smart. You had to know how to play. You had to know how to play poker, right? Because you had to know how to represent yourself, and you didn't learn that in college, right? You learned that from being street smart. You learned that by having a very aggressive Type A personality. It was really unbelievable, and so that's how it started. And then that summer, I didn't want to leave by the time August came. But it was time to go back to college, and I wanted to go to college, so I went back. But I got the opportunity to come back every summer, 82 and then the summer of 83, which was really the defining summer of this whole experience. Because in 1983, now we were well into the Reagan presidency. They had just passed the tax reform bill, so we were in the middle of this kind of sea change in the economy. Interest rates were 21%. Interest rates were 21%. Wow. Unemployment was 13%. Inflation was running at 10%. It was a disaster in this country, right? And kids getting out of college couldn't get a job, and guys who were my age then were getting thrown out. The same way that we saw during the great financial crisis when we went through that, disaster. But I went back in the summer of 1983 for the guy that I had worked for, this independent broker I had worked for in the summer of 80, 81, 82. And things were so bad that this guy couldn't even afford to have me. Now, understand, I was making $125 a week to be a summer intern for this guy, but it was just the extra $125 that it wasn't in the budget, right? And the Dow was trading at 892, and we might have traded 30 million shares a day. Today, we trade 30 million shares in about a minute and a half. That's the difference, right? Because we did it in a day, and you did it all by pen and paper. And so I thought to myself in the summer of 1983 when I came back that, okay, maybe this is the summer I'm going to go be lifeguard on the beach because, I came there and he basically couldn't have me. But by this time I had gotten to know a number of people on the floor, other brokers, and so I went around saying hello to people. And I went over to this one other broker who is a salt of the earth. I love this man. And he puts his arm around me, welcomes me back, and how you doing, and how was school, and what are you doing? And I said to him, listen, everything's great other than Doug can't afford to have me this summer, right? I mean, his business is bad, and so it's just another expense he can't have. I said, so I'm just kind of looking around to see if there's another opportunity before I decide to go back and be a lifeguard on the beach. So he puts his arm around me, and he said to me, "Hey, kid, you know the symbol for IBM?" Yes, IBM. He said, "You know the difference between a buy and a sell?" "Yes, sir." "You know the difference between an eighth and a quarter?" I go, "I think so." He goes, "How's $225 a week?" "Are you kidding me? I just got a raise." It was the greatest day of my life. I said, "When can I start?" "Like right now." And so that's what I did. In the summer of 1983, I was working for this other guy, and his business was actually different. He was actually doing a lot of business because he did a lot of the option layoff business, which was becoming part of the financial services experience. So he was in the right place at the right time. And so I was there during the summer of 1983, and the most dramatic thing that happened, and some people that are watching this will remember it and others won't, was what happened on Tuesday, August 17th. And it was a Tuesday morning. And on the Monday afternoon on the 16th, there was this rumor that went around the industry, kind of the floor. It was coming down through different brokers on the phones, that there was going to be the surprise announcement on Tuesday morning from the Fed. Well, here was the deal. The Fed never made surprise announcements. The Fed came out at 8:30 on Thursday mornings. They opened the door. They stepped out. They told you what they did. They turned around. They closed the door. They didn't sit there and hold your hand and give you a Xanax and say, "You okay with this? Let's talk about it." Nothing. They came out. They said what they said. They walked in. It was up to the market to figure out what was next.
Right.
And so the idea that the Fed was going to come out with this surprise announcement on Tuesday morning made no sense to anybody because the Fed never did that. So remember, this is 1983. There's no internet. There's no television on the floor. There's no radio. There's no outside sources to poison the mind on the floor. Everything we got came from the phones. People outside that would call down and tell you what happened in the world.
Right.
It was really spectacular. And so as Tuesday morning came, as we approached 8:30, there were 5,000 people on the floor. And so it was typically a noisy, kind of boisterous place. But as we approached 8:30 that morning, I'll never forget it, the room kind of got quiet because everyone was waiting to see if there was this surprise announcement coming. And at about 8:30 and 30 seconds, every single phone on the floor lit up. And they were the old-fashioned phones, the metal phones with the push buttons that would ring,
right.
like a ring. Today they sing songs and they do all that stuff, but it was like a ring, right? And every phone lit up, and it felt like Christmas because when you picked up the phone, everyone on the other side was like, "Did you see what happened?" You said, "No, I didn't see what happened. What happened?" Because you couldn't see what happened.
Right.
And what happened was Paul Volcker, who was Fed chair, came out and made this announcement that he was cutting interest rates by 10%. Now, when rates were 21%, 10% was a huge move. It was 2 full percentage points. Right. And so that was the birth of the bull market, right? August 17th, 1982 was really the birth of what then became a 25-year bull market. And he drew the line in the sand that day that rates were coming down. He was going to break the back of unemployment, break the back of inflation. He was going to force money out of the banks and into the market. Because look, if you were anyone who had any money at all, if you could take your money and go to the bank and get 21% guaranteed riskless sleep at night, or you go out and you buy American companies, which are beautiful companies, Johnson & Johnson, General Electric, all great companies, but there's risk in those companies. And so listen, you have to balance it out. Do I buy something that's risky, or do I put my money in the bank at 21%? 21%, think about that for 1 minute, guaranteed, and sleep at night.
Right.
And so all this money was in the banks. And so when he came out with this announcement, he lit that fire. The money started coming out of the banks and into the market exploded. And that day, what was really amazing, the market was up 4.5%.
Wow.
Well, 4.5% was 35 points.
Yeah.
But it wasn't the 35 points. It was the 4.5%. Today, 4.5% would be 1,500 points or whatever the number is, right? I mean, it would be and on Monday we traded 30 million shares all by hand, and on Tuesday we traded 138 million shares in the same 6-hour time span, all on pen and paper. It was the most amazing day. Like I can remember it like it was yesterday. And that's what got me into it. I mean, I couldn't stand it anymore. It was so exciting for me. But I had to go back for my senior year in college.
Do you miss those days?
I do. Yeah. I miss those days tremendously because that was really the guts of the place. It was the people. It was the excitement. It was the energy. It was the personalities that made the place what it was, right? And it was the time in this country. It was the time in the century when everything was just starting to click and the world was, the world was ablaze in great economic prosperity. And certainly this country, that was the beginning of the turnaround. It was the most amazing place in the world. I couldn't wait. I couldn't wait to get up. I jumped out of bed at 4 o'clock every morning. I couldn't wait to get there because every day was a different day. And the energy in the room, like I said, you take 5,000 type A personalities and put them all in one room.
Yeah.
And then you tell me what the energy level is, right? And if the market's up, the energy's up here. If the market's down, the energy's up here. It's a different energy, but you can feel it. You know, like when you go to a concert and you're standing in front of the speakers and they play the music and the music just goes right through you. You can feel it in every bone in your body.
Right.
It was like that every single day.
Wow.
It was the most amazing place in the whole world.
How's it different now?
Well, it's very automated. It's very 21st century. That's great, wonderful, very efficient. But the people are all gone, right? Because the automation, that's what automation does. I mean, who's kidding who?
So you don't have that craziness going on in the floor exchange
There's
anymore.
no craziness going on. And it's not, I don't mean that to be in a bad way, because it's very modern, it's very 21st century, it's very efficient. It is still the New York Stock Exchange. It is still at the very core of capitalism. It's just different, right? It's evolved.
Right.
But what's happened as a result of the technology is that 5,300 people are gone. There's 200 people left, 225 people maybe left on the floor of the exchange as members, right? As men and women that are actually helping to trade stock and make markets. And it's not a negative on the exchange. It's evolving, right? That technology just forced that evolution, not only here but around the world, because exchanges around the world are like that, right? Most of the human beings that sat in those positions are no longer there because the technology's been replaced. And so today it's a vastly different place in that sense. But it's still, it's still at the very heartbeat of American capitalism.
You made the transition from the old days into the modern world.
I did.
Are there a lot of people that didn't?
Well, yes, but there's a number of reasons why, right? Because as we were making that transition, as you came into the 90s, it was really the conversation started kind of in the early 90s, because here was the deal. The U.S., out of the three major market centers, Asia, Europe, and the U.S., we're by far the biggest market center out of all three of them. But yet the other centers had already automated. They automated back in the late 80s and very early 90s. So they were already trading in decimals. They were already trading and using technology. The U.S., the biggest capital market in the world, we're still trading with 5,500 people, pen to paper, face to face, eighths and quarter of a dollar, right? And it's now 1992, 93. And so the conversation about what the future was going to look like was all about technology. But yet now it's 1992, 93. And what was going to happen 7 years out was this thing called Y2K that, had the world ablaze, because remember those conversations about the world was going to collapse and GPS was going to fall and satellites were going to fail and planes were going to fall out of the sky and utilities weren't going to pump water, right? Because the computer was written, the way the code was written, the date was written in two decimal places. So, it was 99. And so when we went from 12/31/99 to 1100, the computer started, we were going backwards and not forwards, and everything was going to fail. And so there was this rush around the world, not only in this country, it was really around the world, about upgrading technology. Whether you upgraded it, whether you replaced it. And so being a tech investor or being on the floor of the exchange during that time was tremendously exciting, just because there was so much happening around the world. And so this country made a decision, partly because there were only 7 years to go before we hit Y2K. And look, 7 years sounds like a long time, but when you've got to completely take the U.S. capital market system and destroy every handwritten rule that was written in the SEC Acts of 33 and 34, and then rewrite automated rule sets and then put it out there for comment, and then make sure everybody can connect and make sure that the information travels back and forth the right way, 7 years is not a long time. And so partly it was by design. The country made the decision that we would clearly start to move ahead. And so that was all being done kind of in the background. And we continued to trade pen to paper, eighths of a dollar, then sixteenths of a dollar as we got closer to the year 2000, until we went through the turn of the century. Because look, if we went through the turn of the century and the technology failed, guess who's going to be standing there going, we're okay, was the United States, because we're still doing this. The rest of the world was doing it automatically. And if it failed, they were the ones that were going to get hurt, not us, right? And so there was a little method to that madness. But the minute we went through Y2K and the world didn't fall apart, then the push to automate really hit the U.S. markets. And so the transition began. It began soon after 2000, probably March or so of 2000, when they started to decimalize. Because in order to use technology, you had to decimalize.
So what's incomprehensible is that 5,500 people are face to face, and
unbelievable.
It worked. In other words, no mistakes, things settled at the end of the day.
Things settled. Listen, you would hear the occasional mistake, but the occasional mistake became very expensive.
Yeah.
And so once you made a really expensive mistake, you didn't make that mistake again. Right? So it was trial by fire. But the sense is, the most amazing part is that yes, with all those people, with what appeared to be so chaotic as an outsider looking in, was not chaotic at all. It was, in my mind, it was very efficient. It was very exciting, and you just multitask. I could be in 3 different stocks at once, and I could be standing with you in Coke, but listening to what's going on in IBM or listening to what's going on in Delta Airlines, and be able to react to whatever I heard, because that's the way it was.
And this is why you're saying street smart kids were the ones who could do that, not necessarily the Ivy League graduate that's coming in.
Right, because you didn't learn this in college. You go to college and you learn principles and economic theory. Great, wonderful. It's not what you did on the floor of the exchange at all. You had to be able to react. When I had an order from a client, and listen, clients were not retail. We're not talking about going in and buying 100 shares of Coke or 50 shares of telephone for your kid's retirement account. Right. You're talking about representing institutions, asset managers, mutual funds, hedge funds, pension plans, foundations that need to buy 1 million shares of Coke or 200,000 shares of IBM. Right. And so when you walked into the crowd, you had to be able to read the crowd. You had to be able to understand what your client wanted to do, because my client could have been on the other side of the country. But at the moment, he was sitting here right on my shoulder, right? Because in my hand, there was an order. I got to buy 150,000 IBM, and here are the parameters that he or she wants to buy it under. Right. He told me that. She told me that. So when I walked into the crowd, I knew that information. I knew what I needed to do. But now I had to assess what the crowd was doing and what the market was doing, what the stock was doing, what the total market was doing, maybe what one of the competitors in this industry was doing that might affect what I'm doing.
Right.
And so you had to synthesize all that information. And you had to walk into a crowd and you had to ask the questions, which was another reason technology wouldn't have worked at the time, because so much of it was driven by the conversation that you and I had, that he and I had, that she and I had, based on I'd walk into a crowd and I'd say, how's IBM? And the specialist would represent his interest. But then he might say to me, I've got 2 buyers and a seller. And so it was up to me to then have that conversation with all the participants, so then I could understand what the market was. And so that's where all the information was. That's what made it the most dramatic, exciting place in the world, because it was anyone that wanted to buy and sell IBM at that moment in time had to be standing there. They had to be there, and they had to participate. And if you said nothing, then you weren't included. If I walked in and I said, what are you doing at IBM? And you said you have nothing to do, then you have nothing to do. So then if I'm a buyer and I go take the stock at a quarter and you go, I can sell 50 at a quarter. No. You didn't offer anything. I'm taking the 50 from him because you didn't open your mouth.
Right.
So I didn't know you were there. He opened his mouth. So guess what? I'd trade with him. Now, it's your offer afterwards if you still want to make an offer. But so
it was like a code of conduct.
It was a code of conduct. But that's what made it the place it was, because it was understood that there was this code of conduct, and everybody operated and everybody understood the code of conduct.
So now it's gotten sterilized, right? I mean, there's
sterilized. It's gotten neutered. It's gotten sterilized for sure, because none of that conversation exists anymore, because it's all automated, and you can't talk to the computer, and the computer doesn't react. And people always thought that it was the boys' club, that you and I were buddies, and so wink, wink, It's not the way it was at all, because I had a client to represent. You had a client to represent. You and I could be the best of friends, but guess what? Between 9:30 and 4 o'clock, if we had to go head-to-head, we went head-to-head, because you were representing your client and I was representing mine. I'm trying to get the best price for my buyer. You're trying to get the best price for your seller. So you're interacting with all the other people in the crowd. And so therefore, it was dramatic. It was so unbelievable. And then at 4 o'clock, no matter what happened during the day, we could have been going head-to-head all day. And at 4 o'clock, I'm saying, come on, let's go out for a beer. Because that's just the way it was. It was this camaraderie, it was this collegiality that didn't exist anywhere in the world.
So I'm just curious how a timid introvert like you got the job.
Timid and introverted, you weren't there. I mean, you would have gotten run over, right? You would have gotten run over if you were timid and introverted. There was nobody timid and introverted. Now, maybe they weren't, listen, I'm very excitable. Maybe they weren't as excitable as me, but they were not type B personalities. Everyone was a type A.
Got it.
I met my wife on the floor of the exchange. My wife was a member of the New York Stock Exchange at a time when there were, 8 or 10 women who were physically members, like running around the floor as physical members. There were women who were quote unquote members, because you have to understand the difference. If you and your wife were married and you owned a seat on the New York Stock Exchange, it had to be in one person's name, so it might be in your name. But if you passed away, that's an asset that would then pass to your wife. So now the seat's in her name. She becomes the member, but she's not the working member. See, there's a difference when I say the member. There were plenty of women who were members because they owned a seat, but they didn't actually physically work it. So my wife was one of the working members on the floor. And at the time, it was 1984 when she became a member. And women were just banging their heads on the ceiling like, in the late 70s.
Yeah. How many total members are there in the stock exchange?
Well, then there were 1,366 members, and then the other 4,000 people were all support.
Right.
Today, there are 250 maybe.
Wow.
And all the support people are gone because
So now,
the technology.
with how things have evolved, if for the typical person out there in the world, is now they have more opportunity to earn money in the market, or was it better back then for them?
No, in that sense, the game hasn't changed. The market is still the market, and the capital markets serve a function, right? Because they allow people to participate. They allow the average American to be able to buy stock in U.S. companies as well as international companies now that trade on the floor of the exchange, and invest their money to generate wealth and income for generations. And so that opportunity hasn't changed. That opportunity is still there. The difference though today is there's so much more noise today than there was. Partly because in the 80s and 90s when there were only 7 price points, it was an 8 1/4, 3 8 5 6 7 8 between every full figure. That's all there was. Today there's 1,000 price points because the exchanges trade in 2 decimals, so that's 100 price points, right? A penny to 99 cents. But then the dark pools, the alternative venues, the internalization engines trade out 4 decimal places. So they can trade out at 0.0001 all the way up to 9999, which creates 1,000 price points with every full figure. And so therefore, that is what's caused a lot of the noise.
When you say noise, what do you mean by noise?
Well, noise, what I mean is noise in the market, noise in the way stocks trade, right? When we traded in 1/8 of a dollar and 7 price points, it was very defined. You would see blocks of stock trade. 20,000 would trade at a half, 50,000 would trade at 3/8, 50,000 would trade at a half again. And so you could see volume around price, and so there was less noise. Today, because there's 1,000 price points, and because it's all algorithmically driven, what you don't see anymore is you don't see the big prints because nobody prints 50,000 or 100,000 shares anymore, right? They take their order and they break it down into 100 share units and they spray the market across the 11 exchanges plus the 50 different alternative venues that now exist. They spray the market. So everyone's trading in small lots. And so the noise that's the noise. Because you can't, there was an art to reading the tape. Back in the 80s and 90s when you would see the ticket tape go by, you'd see the volume and the prices. And if you were a good trader, you could read the tape. You understood where the market was going. You understood where that stock was going. You understood where the sector is. You would see, IBM and other tech stocks, trading up.
Right.
You would see that there was demand. You could tell by the tape. Today it's more difficult to see because the noise that's created by the multiple 100 share prints, you can't really read it anymore. Right?
So for an investor now that wants to come in and say, hey, I want to trade this market, I want to see if I can invest, trade, what have you. Are they going to be eaten up by these tech people who know how to get in there and do this?
No, so that's a great question. But here's what I would say to an investor. Because there's a difference between an investor and a trader, right? An investor, you have a much different time horizon on your hand. You have a much different plan, right? You're investing for something in the future, whether it's your retirement 30 years out, whether it's for some wedding, whether it's to buy a house, but you're investing for a longer period of time. And so what that person needs to do is eliminate that noise. They can't pay attention to the daily machinations of what the trader wants to do or what the algorithms are doing. They have to say, look, here's my goal. Here's how I have to do it. I like Coca-Cola and I like GE and I like IBM and I like Intel and Apple and whatever they like. And then they put the plan together. And then they methodically follow that plan. Whether the market's up or down, they methodically follow it. Now look, if you want to allocate $1,000 a month, okay, and the market's on 1 month, Apple's trading at a high. Okay, so you're going to take the $1,000, you're going to buy $1,000 worth of Apple. Next month, if Apple's come under pressure, now it's trading down 10 points, you're going to take that same $1,000 and still buy $1,000 of Apple, except you're going to buy more Apple because the price is lower. So over time, you average, you get an average in prices, and so that's how you really build a portfolio. Now, if you're talking about the trader loves the volatility. The trader loves it. The trader wants more noise because he's not investing, he's trading or she's trading, right? When I say he, I'm
Yeah.
I'm talking about everybody.
Right.
He, she, right? But
You're right.
they want that noise because they're a trader. They're not an investor. So they're making money based on how the stock moves. Is it, it could be within a 2-minute time span, it could be in a 10-minute time span, it could be in a day. But their focus is different from the investor.
So they're trading off of volatility.
They're trading off the volatility. They're trading off the noise that's created today on the internet, on Twitter, on LinkedIn, on Facebook, on Google, on Amazon. They're trading all that noise. And now, today what exists, which didn't exist then, are the smart logic algorithms. Smart logic algorithms are exactly that. They scan and scrape the headlines, whether it's in the Wall Street Journal, the Washington Post, the New York Times, or Bloomberg, or on Twitter, or on Facebook, whatever headline it can see. And the smart logic algorithms are written in such a way that they react to words. Is the word positive? Is the word negative? Is the headline positive? Is the headline negative? And when it is, then the algorithm then assumes or makes a decision that's a negative headline, negative for the market. They initiate sell orders. At the same time, they withdraw the inline buy-side interest, which creates a vacuum of prices, which is why you see the volatility that you see.
Wow.
Right? But doesn't mean as an investor you shouldn't take advantage of that, because you should. Because most of the time, that volatility is short-term noise, and in that noise it creates opportunity. Because it dislocates a stock temporarily, and if you're a long-term investor and you were buying Coke at 50 and now it's trading at 46 because of the noise, damn, I'll buy more at 46. I loved it at 50. I damn well love it at 46.
Yeah.
Right?
So what's interesting is how much psychology still drives the market, because but now it's automated psychology, right? If you're going out and grabbing headlines and words and so on, saying, "Oh, we're going to trade based on headlines, not based on analytics."
You as the trader, you've pre-programmed your computer, so you're not really even doing it. You've pre-programmed your computer to respond to how the algorithm reads the market.
Right.
So if the market trades down, your black box is going to generate buy and or sell orders based on what's happening in the market. You're just sitting there. You're reading the paper. You're doing other work. I mean, you're clearly going to oversee it.
Yes.
But you're not actually sitting there every time it happens and typing in, buy 100 shares of this, sell 200 shares of that. You're not doing that. The computer's doing that.
Well, and that's what's amazing to me, because I would have figured, it became somewhat impartial when you got into algorithmic trading.
Right.
But it's looking for certain words that carry certain emotions.
That's correct. Now listen, and that's the frustrating part of it for a lot of people, because you and I can have that same headline, and you and I could talk about it. Okay, it's a ridiculous headline.
Right.
But we understand that, because we can interpret the headline and have a conversation and not react. The algorithm can't interpret that. All the algorithm knows is that word's negative or that headline's negative. Meanwhile, it really isn't.
Right.
It might feel like it is, but it isn't. But the algorithm reacts. The market either takes off or sells off. So for instance, here's a perfect example. Back in the middle of the crisis in 2010, when global markets were just they were crushed, they were up, they were down, they were up. This one day, remember when the European banks were getting just crushed? And so every week there was a meeting in Brussels amongst the European Union and 27 member countries getting together trying to figure out what to do. And Germany and Angela Merkel was at the head of the table, because Germany was Germany, right? Was kind of in control of the whole place. And I'll never forget it. And this is just one of so many stories like this. But, it was all about the meeting in Brussels, and everyone's hanging on every word that's going to happen. And Angela Merkel stands up and leaves the room. And so the Twitter lights up. Merkel just left the room. Okay, is that positive or is that negative? I'm not really sure. Is that a negative headline or is that a positive? It was viewed as a negative headline because Angela Merkel is Germany, representing Germany, and she picks up and leaves the room. So the market sells off. The poor woman had to go to the bathroom.
I was just about to say, maybe she just had to go to the bathroom.
That's all she had to do. Meanwhile, 5 minutes later, she comes walking back in, and the Twitter headline says, Merkel enters the room, and then the market takes off again. But you see how ridiculous that is?
I was going to make that as a joke.
No, but that is the truth. The funny part about it is, it would be a joke. But it's not a joke. Because the Twitter, things like Twitter and LinkedIn and Facebook have created all this noise that creates this volatility. And so Angela Merkel does leave the room.
Wow.
Okay, but Twitter viewed that as a negative because we're in the middle of these negotiations. And then she comes back in the room, so they go, oh, wow, she's back, everything's great. And so, the market sells off and the market rallies. And part of that is what annoys the investing public, because they don't understand the volatility in the market. Like, why does the market do that? And so therefore, it gives the impression that the market is more of a casino than a place to invest.
Right.
That's the wrong message. And this is where I get so worked up about the way the industry and the SEC has allowed that to evolve. But listen, there's a lot of pressure from the tech industry, clearly, because they stand to benefit.
Right, right.
And so, it's the 21st century, you have to be modern. Okay, great. So what I spend my time trying to do is I try to make people understand that it is not really a casino. If you're a long-term investor, there's huge opportunity to invest in the market. Huge. There are plenty of great companies out there that you would do very well by creating a portfolio. You as an investor just have to learn to eliminate the noise.
Yeah.
And that's, I think, that's the hardest part. And it's especially the hardest part for people that are maybe our generation that understand what it used to be like. Millennials say they don't know any different. That's just what it is. So to them, it's normal. It's not normal.
So if I'm somebody who say, okay, I want to be an investor in the market.
Yeah.
I've got 401k, I've got IRAs, I've got whatever I've got.
Yeah.
Am I smarter to buy indexes, to bet on individual companies? Yeah, what do you advise people?
Well, so it depends on your personality, depends on your profile, meaning your risk profile. Do you tend to be a type A or a type B personality? ETFs and mutual funds is much more passive investing, which are fine. They do that does very well, and it also relieves you of the sense that you always have to be checking your phone or looking at where the stock is trading because I bought it at 50. Oh my God, it's trading at 49, and you make yourself crazy. Right? In an ETF, it's less so, and it's passive investing.
ETF means what?
Exchange traded fund. And an exchange traded fund is like a mutual fund, except it trades like a stock. So you can buy it and sell it intraday. Mutual fund, you buy it, you get the price at the end of the day.
Right.
So if you put an order in buy a mutual fund today, you're going to get the closing price tonight. If you put an order in to sell the mutual fund today, you're going to get the closing price tonight. And an ETF, like a technology ETF, so it's a mutual fund that's made up of all these different technology stocks that trades like a stock that you can buy and sell all day long.
Right.
That moves like a stock and you can buy it and sell it all day long. And so that's a form of passive investing. It kind of lit up in the late 90s. Started with the S&P, right? The S&P 500. And now you can buy an ETF. I can't even imagine. I bet you there's more than 5,000 ETFs out there that you can trade anything under the sun, any country, any combination, because they're all very inventive, right? In terms of exposure that you can get. And a lot of those ETFs are not meant for Joe Q public, the average investor. Things like a technology ETF or financials or the consumer discretionaries, those are great. But they've also got ETFs that are really designed for the traders and for the big hedge funds that are managing risk. And so you can get ETFs that are levered 2 and 3 times. Which really means, if the market's up 100 and you buy an ETF that's levered 3 times, you're going to be up 300.
Right.
Conversely, if the market's down 100, you're going to be down 300.
Right.
And so those aren't meant for the individual investor. And I would never suggest that an individual investor go anywhere near them. But the problem is everybody plays in the same sandbox. And so everybody gets dragged down or they get dragged up. And so you have to be able to understand that as well. So depending on your level of risk, and what you can stand, and where you are in your life. Are you 30? Are you 60? That's going to make a difference as well.
And you're getting to my next question is saying, okay, so I'm realizing, like you're saying, there's different approaches for different types of people.
Right.
So it's not just this kind of didactic thing. You got to know the human. What are the most important questions to ask yourself?
Well, what's your risk profile?
Right.
What's your tolerance level? Where are you in your life? What do you have to provide for? Do you have 10 kids at home that you're trying to provide for? Do you have no kids at home? Is it just you and your wife? Do you want to retire at 40? Do you want to retire at 70? And so there's a lot of questions, and most of it, though, revolves around risk. Really, what's your risk tolerance level? What's your wife's risk or your partner's risk tolerance level?
Right.
Because you're in this together. I think one of the most important things, and I wish somebody really had this conversation with me when I was their age, is that especially if you partner up with somebody, and this becomes your life partner, is that both of you have to be on the same page. You have to. You can't have one person, that's way out here in the risk spectrum and the other one that's way over here in the risk spectrum, because then you're going to have a hard time trying to come to the middle. Doesn't mean you can't have those opinions, but you have to find a way to come to the middle so that everybody feels, compromised, and everybody feels like they get a little protection on this side, they get a little protection on that side. But I think those are the questions as an investor that you want to ask, and so you want to lay out your time frame. You want to put together if you're an active investor, meaning you want to buy individual stocks, then you got a lot of homework to do. because there's a lot of stocks out there. So you're going to do all your homework to figure out what are the right stocks. What fits my profile? What do I like? Am I more conservative? Am I more risky? Do I want high growth? Do I want value? Do I want some combination? Right?
Does it make sense to buy, if you're going to do individual stocks, does it make sense to buy things that you are interested in or care about because you're likely to want to follow it?
Of course.
Yeah.
Of course. That was I think that was Peter Lynch's mantra. You know what I mean? Buy what you like.
Yeah.
Buy what you understand. Like, for instance, I don't own Facebook. I would never own Facebook.
Why?
I don't use Facebook. And so therefore, I would never buy it. I don't care. It's gone up 500%. I would never use Facebook. So therefore, I would never buy Facebook. I just wouldn't. Right?
What kind of things do you buy? What do you like?
So I tend to be a little bit more on the conservative side and the value side, right? There is a part of the portfolio that's got growth in it, for sure, because it needs to. But I tend to be more the straight and narrow. I know you wouldn't necessarily tell that by my personality, but I tend to be more of the straight and narrow. And so, it's like the turtle and the tortoise and the hare, right? Slow and steady wins the race.
Right.
Yeah, you can run real fast, but you're going to get slammed the next day. Slow and steady for me, and I would advise for most people, especially if you're a doctor, you're a lawyer, you're something else, you're not in this industry, that slow and steady wins the race. And listen, investing is dynamic. It's not static. It's not like you say, okay, I'm going to buy Apple and Johnson & Johnson and GE and then just let it sit there for the rest of my life. No, you're going to buy those. But when they make certain outsized moves, you might trim a little bit and then buy something else. You still keep a core position, but you're not going to necessarily sell it all. But you're going to trim. You're going to take some of that cash and reinvest it in a new opportunity. And so it's very dynamic. And that's the other thing. If you're going to be an active investor, if you're going to be a passive investor, it's still dynamic, but less so, because you're going to have. You're going to have your technology exposure through an ETF. You're going to have your consumer durable exposure through an ETF. You might have international exposure. And then as the market goes through its cycles, again, you're going to do the same thing with the ETF. If technology stocks really take off and the ETF is really surged in value, you might take a little bit off the top and put it to work in something else. Doesn't mean take it all off. It could, but it doesn't necessarily mean that. That's what I mean about investing is dynamic. You can't just put it there and leave it.
So you're at this point late 50s, I guess, if I'm doing my math.
58.
58,
you
okay.
can say it.
Yeah. So let's say when you were 30, what were you doing then as far as investing versus now at 58?
So when I was 30, I was really just building, right? Because I was young. I had gotten married at 25. I had a child at 26. I bought a house, and so assets were being diverted to other forms of investment. A house was an investment for sure. But I didn't have a lot of extra cash at the time, but the cash I did have, I had in a 401k or an IRA, and so therefore that's the way it was invested at first, because most of the money I was making was going towards kind of living my life, right? But yet I started to build a portfolio, like I said, that reflected both me and my wife, right? Because my wife also grew up in this industry. And she worked on the floor. She certainly understood it. She understood supply and demand. She understood what the news meant. She understood what investing was, right? And so we put a plan together. It tended to be a little bit more conservative, not way out in the spectrum. It was all stocks when I was 30. It was no fixed income because I was way too young.
Right.
But they tended to be more, it was Procter & Gamble. It was Disney. It was Coca-Cola. It was all these things that I know and I love, right? Stuff you know.
Right.
And so today, then as you move along and you get older and your life changes and your kids grow up and then you potentially have grandchildren and what are you going to do there and what's the portfolio going to look like? So now that you're 58, so it takes on a different tone.
Right.
There's a little bit more fixed income in there to add some stability.
What do you mean by fixed income?
Bonds.
Okay.
To add some stability. There's and see now at my age now, there's going to be more, especially in the environment that we're in with rates being almost negative.
Right.
You want stocks that have great dividend yields, right? Because you're going to get income from that.
Right.
But they're also going to be stocks that you're going to hold. Again, some of the big Americana names, right? And so, listen, I from that point of view, I'm really boring. I mean, maybe I don't look boring, but from that point of view, because I tend to be a little bit more conservative.
Right.
Because listen, I'm 58, right?
So I hear people that are critical. Some gurus of 401ks, like saying, that's there's so many fees, et cetera, you're deferring tax, but you're gonna have to pay, and maybe taxes are gonna be higher. What are your thoughts on that?
Well, taxes are gonna be higher, but the whole point of the 401k and the IRA is that you don't take that money out until you're older when when your income bracket is going to be lower. So that was really the way it was designed, right? So when you took the money out in an IRA, if you put the money in pre-tax, then when you take it out, you have to pay tax on it.
Right.
In a Roth IRA, it's different because you pay the taxes, then you put the money in, and then you pay no tax at the end.
Right.
But the Roth is relatively new compared to the IRA.
Sure.
But that is the difference, right? I wouldn't necessarily, listen, I think any of the savings vehicles, 401ks, SEP plans, IRAs, Roth IRAs, I think they're all tremendous plans for Americans to take care of themselves because who knows what's going to happen to Social Security. And listen, if you're depending on your $2,000 a month to live on Social Security, you better think about working till you die.
Right.
Because that ain't happening. And so all those savings plans, in my mind, are great. And the government encourages you to do it. And you get a benefit for doing it. So you should be doing it. And whether or not you're 30 years old, whether or not you start by putting $100 a month away, whatever it is, just put it away. You'd be very surprised 30 years later what happens. And then, as you become a little bit more successful, the 100 turns into 200, the 200 turns into 500, the 500 turns into 1,000. And it ends up compounding and adding up fairly quickly. I mean, fairly quickly. It's 30 years out, but when you run the model and you see what that's going to look like, okay, so you're 30, and then you figure out if I put $500 a month away for the next 30 years and I earn 7%, all of a sudden that $500 a month is going to be $1 million, whatever the number is, right? Right? There's a calculation. You can do it on Quicken. You can all these different places. It'll give you what the expectation is, depending on the parameters you put in, right? So no, I don't. I think all the savings vehicles, retirement savings, I think they're tremendous.
What are most of your activities today now? You've got all this experience behind you. You've seen the transition from the old days to the new days, et cetera. What do you do now?
So after 38 years, I finally left the New York Stock Exchange because listen, I had a tremendous career there. I wouldn't have changed that for anything in my life. Partly, first of all, because I met my wife there, and then I got married. Now I have 2 beautiful children. Had I not been there, I would never have met her. Who knows what my life would have been, but one way or the other. And I lived through the turn of the century. I lived through kind of all the automation. I lived through the exchanges going public. I lived through the crash of, 2007, 8, 9, 10, 11, 12. And then I finally, in January of this year, decided that it was now time for chapter 2 in my life.
Right.
That, the business that I had on the floor didn't exist anymore because the technology really, really did away with it. And what I recognized ultimately was that it wasn't fun for me anymore. Not that the industry is not fun, and not that being at the New York Stock Exchange wasn't fun. It wasn't that at all. It was just that the automation is such now that you go to your desk, you don't talk to anybody because the phone doesn't ring anymore because everyone sends you, order flow comes electronically, and they send you instant messages because that's all the millennials had to do. Nobody wants to talk. I want to talk to somebody, but nobody wants to talk, right? They all want to send Bloomberg messages and instant messages. Not me. The 25-year-olds and the 30-year-olds, great, go at it. At least in this business, to be able to relay that action in the stock and be able to make decisions and strategize and be able to be creative with the client, that's what made it so exciting and interesting. Because again, everyone's got to listen, you could have a client that's like a type B, very, type B personality, and then you're trying to get him to understand what's going on in the stock and why he needs to be more excited or why he needs to check, and so it took finesse, it took the ability to be able to sell that story. And if you really want to buy this stock, because listen, a mutual fund's going to buy Boeing. They're not going to buy it and sell it in 10 minutes. They're buying it because 4 years from now, they say it's going to go up 70%, and then they want to sell it up 70%.
Right.
They're not buying it to sell it right away. And so you had to be able to tell that story, why you should be a little bit more aggressive or less aggressive, depending on what was happening. And so it was all very strategic. You picked up the phone and you talked to somebody. Again, today, they don't do that just because it's all automated.
So what are you doing now?
Well, I moved to Florida, and I joined I took all this experience, which makes perfect sense, and joined a wealth management firm as a senior market strategist and advisor. And it makes perfect sense for me because it fits my personality. It takes all my experience, both institutional, and brings it kind of to the retail level and allows me to have these conversations with high net worth and ultra high net worth individuals. And so it makes perfect sense for me. And I did, once I left once I left the New York Stock Exchange, there was no reason any longer to have to live in New York. My kids are grown.
Right.
And so there was no reason to have to live in New York. And the truth is, the weather's nicer in Florida.
And it shows by your tan.
Oh, thank you.
So now, we've got people who are trying to sort through all this, and I know a lot of times, second nature terms to you are, not, or maybe mystifying to other people. Like you talk about, retail, versus, institutions, or you talk about. I heard you earlier talk about market makers. So maybe let's talk about maybe a few of the terms that people should understand so they can navigate this landscape a little bit. So what's retail versus
So retail, think about retail as you as an individual. You, your wife, your parents, your brothers, your sister, whatever. The retail is the individual. Institutions are asset managers. Mutual funds are institutions. Hedge funds are institutions.
What's a hedge fund?
Okay, so a hedge fund is an asset manager that pools the assets of investors, and they bring the money together. So instead of you singly, you come into this hedge fund, and 10 guys give him $1 million a piece. Other guys got $10 million, and he levers that 3 or 4 times, and now he's got $40 million. And then he'll trade the market. He'll invest on your behalf, so you participate in everything he does, right? Good and or bad. But a hedge fund, unlike a mutual fund, is a riskier investment. So therefore, the requirements to get in are different because you have to have kind of the capital and the wherewithal and the experience to really, right? And that's all good.
Are they a newer phenomenon?
No.
Because it seems like they're talked about a lot more now than they used to be.
They exploded kind of in the late 80s, mid to late 80s. Hedge funds, because the market was just on fire. And so it created a lot of opportunity for people to trade, so they exploded then. I think they're talking about them now because there have been some real big hedge fund blow-ups, meaning some of these guys have made wrong bets and they've had their heads handed to them, and so that makes the news. A mutual fund, like a hedge fund, is an asset manager, but they're much more conservative. Fidelity's a mutual fund company. I mean, you could just pick up the Wall Street Journal. There's 1,000 mutual fund companies. Right. But they also pool the money of individual investors, retail investors, and so therefore they get a bigger pool of capital to invest. So they go out and they buy 1 million shares of IBM. Right. And if you were singly trying to buy IBM, you're going to go out and buy 200 shares of IBM. And so therefore there's just more bang for your buck if you're involved in a pool of money, right? The retail is just you doing it on your own, right? And the institution is the institution.
What do you think the future holds now? So you've seen all the changes. You've seen old school, new, contemporary market. Now, where's it going?
So let's start with the exchange. The exchanges continue to evolve. Part of it, like most things that technology does, is it forces you to evolve. And so the exchange has continued to evolve. It's very 21st century. It's very, very high tech. And it will continue to evolve based on where technology drives it, right? And I think at some point the technology is going to get so sophisticated that the trading will take place immediately. Like today, when I buy stock or sell stock, there's still the 1 day clearance, and so I buy it, I don't get it till tomorrow. I think in the future, if I buy it, I'm going to buy it, I'm going to have it right now. I'm going to buy it from you, and it's going to be in my account right now.
So
and you're going to have the money right now, and I'm going to have the stock right now. But from an investing perspective, I don't think much changes in the sense that investing is still investing. You want to buy stock, you're going to buy stock. You're going to create a portfolio, you're going to generate wealth for a lifetime. You have to build a portfolio. Whether you build it by thinking about, I want to buy 500 shares of Coke, and you're going to think it, and all of a sudden it's going to be in your account, right? If Google has their way, I'm going to have these glasses on my head, and I'm going to think about it, and all of a sudden it's going to trade, right? But investing is investing. And so the investing game will never change. It might get more complicated, more complex, but see, that in and of itself creates, in my view, creates issues. Because as the products that you create become more complex, then the system becomes more risky. And so the perfect example of that is the crash of 2007, the great financial crisis, 2007, 2008. Because a lot of the products that had been created that were not equity products, and they were all 3-letter acronyms, ABSs, CDSs, CMOs, all these derivative products that were traded against stocks and against the mortgage market and against housing prices and all that stuff were very complex. And the retail public wasn't going out and buying those products. They were all very institutional. But what happened, they were all designed, and this is how it's going to work. And in a perfect environment, this is how they're going to work. And when the environment was perfect and everything traded fine, everyone's patting themselves on the back, saying, look at how great I am, until it didn't. And when the economy started to collapse in 2007, not only the U.S., but the global economy started to come under pressure. And then we all know what happened. It got worse and it got worse. And then what happened is those complex derivative products that were all built and designed and they worked so efficiently and look, this is how it's going to happen, they didn't work so well. And in a down environment or in a difficult economic environment, the whole thing blew up. And so what really happened during that crisis, and people are so quick to blame Wall Street, Wall Street, Wall Street. But when they blame Wall Street, like they're pointing their finger at the New York Stock Exchange. That's not the Wall Street that created all these products. They were the big investment banks. They were all these other people that work in the industry that created these products. But what ended up happening when the economy started to stumble, some of these products became illiquid, right? They became difficult to trade. And then as the economy got worse, they became even more difficult to trade. And you tried to sell it, there's no buyer.
Right.
And so then what do? You start to panic because now you can't sell it. But you want to sell it because you think it's going lower, but there's no one that wants to buy it. So what do? You sell what you can.
Right.
And so you hit the button to sell GE or Coke or Abbott because you know why? Because you can. Because the public markets are the public markets. There's always a bid, there's always an offer. You may not like the bid and offer, but could you sell it? You absolutely could. There were no bids and offers in those complex derivative products. And so everybody around the world, by the way, that owned these products, because that's what they all did, they all sold it to each other. It was a big Ponzi scheme, if you want my opinion. But it all collapsed. And so institutions that owned all that crap around the world could no longer sell it. And so then the world started to panic. And people started, I want my money. Investors who were in those, I want my money, calling up the broker, I want my money, I want my money.
It's like the old run on the bank.
It's all the run on the bank. And so what happened was they sold what they could versus selling what they should have. Right. But they couldn't sell that because there were no buyers. So they sold Coke and Abbott, Johnson and IBM, and they did it, and they did it, and they did it for a year. And the market went down 60%.
Wow.
60%. And so anyone that worked their whole life, that maybe had $2, $3, $4, $5 million in their IRA, lost 60% of its value by the time we hit rock bottom.
Wow.
Right? And so the problem with a lot of those complex products, and my view on the future is we need to be very careful, and the SEC needs to be very careful on what they really allow to be designed and developed. Because remember, I just said it, we all play in the same sandbox. Just like in the crisis of 2007 and 8. We were all playing in that sandbox. I didn't own any of that crap. I didn't own CDSs and CMOs and ABSs.
But it still followed you into this.
Of course it did. And it followed you, and it followed him, and it followed her, and it followed him. Followed everybody. And so therefore, everybody got dragged down, right? And so in retrospect, someone will say, but look at the opportunity it created. Because then stocks, the market was down 60%. Yeah, okay. Unless you were one of the guys that jumped out the window or killed yourself because you lost your life savings.
Yeah.
And remember, I'm not making that up. There were people who did that.
Yeah,
right?
I remember.
And so therefore, what I'm concerned about the future is the level of complexity that the industry allows to be traded in the public markets.
So basically it's a full ecosystem. In other words, you can't just say, well, I'm in stocks,
right,
but I'm not in that other crap.
That's correct.
But the people, when people are in that, or the institutions are in this other stuff, it still follows you back to your investment.
That's right, because it's all in the same sandbox. It's all in the same. Now, ABSs and CDOs, those are all fixed income products. So they weren't in the equity sandbox, but they were in the bigger sandbox of financial services.
Right.
And even though I had no exposure to those those fixed income products, I got slammed in the equity market.
Yeah.
And you did, and he did, and she did.
Yeah.
Because they panicked in that world. They couldn't sell them because there were no bids, and so they sold what they could. You're not going to sell Bank of Hawaii. Who wants to buy Bank of Hawaii? You're going to sell GE and Johnson and Abbott.
But the reality, I guess, was that GE was not really worth less from a technical standpoint. It was a psychological standpoint. Everybody wanted to get cash.
Exactly right.
So on the flip side of that, I guess, if you went in and bought it.
Well, okay, but the problem was, you're exactly right.
Right.
But GE goes from 30 to 25, and you go, oh my God, it's down $5. It's a buy. But then it goes to 20, and then it goes to 12.
Where's the bottom?
And so then you start to say, I just bought it at 30, I bought it at 25, I bought it at 20, and now it's trading at 12. Then you start to panic because now you thought it's the end of the world.
Right.
Right?
And
Now,
that
if
was
you ended up
incidentally-
waiting and you bought it all at 6, where it traded down to, you're a superstar. But who did that?
Yeah. Well, you said it was something that was really a worry at the time, is that it was the end of the world. I mean, the whole thing could just collapse.
Well, the truth is the global financial system came to the brink. And I don't think many people really appreciate how close we came. I don't really think that they really understood how close we came. And the issues with AIG and Goldman Sachs and all these reinsurers, how they were all in bed with each other with these products, and what that really meant. And so in the end, Ben Bernanke and Timmy Geithner, the ECB, the European Central Bank, the IMF, the Bank of Japan, the People's Bank of China, all these central banks around the world did what they had to do because we were on the brink of Armageddon. It wasn't U.S., it was global Armageddon. And so those banks did what they had to do, and people were very critical, but the people that were very critical didn't really understand how close to the edge we were. And so what I'm fearful of, because I think history repeats itself, and that's the problem. And in 20 years, there's not going to be anyone in a position at the Treasury or at the SEC that has any recollection of what happened in 2007. And so my fear is that we're not going to learn, and that we're not going to put rule sets in place that say, no, you can't do this. I don't care what you say, you can't do it.
Right.
And I don't think that's going to happen because I think the banks, the big investment banks, have too much power. I think they get down there and they have too much power.
Yeah.
And because they create these products. And part of it was the products were unregulated. And I would go back to Alan Greenspan on that, because Alan Greenspan said, no, they don't need to be regulated. Well, that's baloney. Because they were unregulated, which is part of the problem.
Right.
So if you want to create the complex products and then regulate them so heavily, maybe, I go, why go there? Why go there?
So then maybe to sum this all up,
Yeah.
as you're looking back through these experiences, you see how really bad things happen, people get wiped out, what have you.
Yeah.
But at this point, you still think that the market is a good investment for people to go into, to buy equities and to invest here.
I think I'll qualify by saying, as a long-term investor, if you're somebody who's 25 or 30 years old and you're just starting, absolutely you should be in the market. How you design it is going to be up to you.
Right.
If you're somebody who's a big risk taker, well, then go for it, but then understand the risk.
Right.
But absolutely you should go into the market. Absolutely. I'm still a buyer of the U.S. capital system. I'm still a buyer of the opportunity that investing creates to generate wealth, not only for you and your partner, your wife, or whatever, and your children and your grandchildren potentially, that it provides. And so I'm absolutely a buyer of America, and I'm a buyer of the investing process for sure.
I guess I could easily say you've seen it all.
Yeah.
And so you have this really great historic and contemporary perspective on the markets and the experience of the markets and what they mean to everyday people in the world. So I appreciate you taking the time, sitting down, sharing all of it. I don't think you held back.
No.
So I appreciate you coming here, showing up, not holding back, and sharing it all.
You're very welcome. It's my pleasure.